who is probably stuck in an older product that costs were very high. They're seeing a negative, want to move out and reinvest somewhere else.
So if you bought a endowment product where if you withdraw your money for maturity, you would always tend to lose. If that's the product that's invested in, the best way is to make it paid up. What does it mean? Don't withdraw it, but because if you withdraw it, you'd probably not even recover the money that you'd invested. Just make the policy paid up, which means that you will stop investing further, but the amounts that you've invested will stay protected, and that amount will be returned to you in the due maturity date. So if we had say invested in 2010 and the maturity date was say 2025, uh, and today is the call that you're taking this call of whether to continue or not. What you could do is you could stop investing any further. So you've already invested for the last 10 years, and now for the next set of investment you could make in a more efficient product. uh, but the amount that you've invested so far, that amount will continue to be protected. Whatever return you've generated, that return will also be protected, and this amount will be returned to you in 2025 when the product would have matured any which ways, which means that you will not lose out on the amount you've invested so far, and there is no penalty on your investment amount. So make it paid up. Don't withdraw it today. Withdraw it at the due maturity date, and you can continue investing in a more shift your investment to a more efficient product. So I think a paid up is a better option than to withdraw and continue the product.
Mhm. Here's a question from Shoyab Shikari. His question is, I'm 28 and I want to invest in a ULIP to cater to my pension. But I also want that every 10 years I will get some returns. Is there any specific plan?
So you could use the whole life ULIP option to go for a pension creation for yourself, which allows you to withdraw every 10 years or every 5 years, and you can decide how much you want to withdraw. There will be no restriction on that. So that's one way to go about it, that you start investing today in a whole life ULIP, which is low cost, like an HDFC Click to Wealth plan or a Bajaj lifelong gold plan that allow you to invest in a monthly mode through an SIP mechanism. And you can start a pension 10 years from now or 15 years from now. You can decide when you want the pension. And you can also decide the pension amount. And in between, if you have to withdraw a larger amount for a one-time usage, you can also do that. So whole life ULIP could be a good option for you to start with.
Hmm. Okay. There is a question coming on suggestions around debt products. Currently, my fund is in a multiple cap growth and opportunity fund in ICICI Pru Life. I think should I switch to an income fund? Is income fund like an FD?
So FD and income fund. So basically, these are all debt instruments. The difference here is that one could be just government securities, and one could be a mixture of government securities or corporate bonds. But both are equally secure, and the better option would be switch to a debt fund than a fixed deposit, because a fixed deposit will attract tax on the profit that you make through a fixed deposit, whereas a debt fund through insurance, the profit will be completely tax free. There is no tax applied on it. So
Hmm.
whatever investment you've made, you can switch from opportunities to a debt fund, the income fund, and you should expect a decent 6 to 8% range of a return, and the amount, the profit that you make through this will be tax free. So that could be a smart thing to do.
Here's a question from Akshay Jaiswal. He says, I'm 21 years old. I want to invest money for my higher education. So please suggest which plan is good for investment and where should I get good returns after 5 years of investment so that I can continue my education with that return.
You could choose any ULIP product. You should choose a direct ULIP product, which means there are no charges on the product apart from fund management charge. And you could choose, so there are a host of options. I would say that you could choose. And given that you're saying 5 years and this is for education, I would say choose a ULIP which is capital guaranteed. So which means that the money that you invest will not erode. So choose that way of investing. You could invest with HDFC, you could invest with Bajaj, you could invest with Edelweiss, which is a good fund management house, or you could also invest with SBI. So any of these products you could choose, and choose the capital guarantee route to invest, which is choose a ULIP with 100% allocation into debt. That's one way to do it. Or choose a solution which is available where some amount gets invested in ULIP equity and some amount gets invested in the fixed benefit product. Those solutions are created and are available on Policy Bazaar. That's one platform you could choose to get these solutions which are already created for you. Or you could choose any of these products, like I mentioned, and invest through a debt.
Hmm. Do these, the 4G ULIPs that you talk about, Santosh, which are the low cost ULIPs, do they have child plans as well? Because there are a lot of questions around that. There's one question coming in from Abhishek Kumar. What's the best investment policy for students? There are a few others as well. So can you have a structured child plan with the rates of the new 4G ULIP, or are those just standardized investment products?
So they all of these products, which are the 5G ULIPs, which have a very strict charge structure, and these products only have a fund management charge, and even the mortality charge is returned at the end of the maturity period. These All of these products have a child variant as well, and the child variant allows you to stay invested, and whoever is the proposer or whoever is the parent who is making this investment for the child's education, even if the person weren't around, and if any unfortunate incident were to happen to the parent, the future premiums will be paid by the insurance company, which means that the final fund or the final amount that you had set your a goal for, that amount is protected. So they do have a child variant. So if you check HDFC Life Click to Wealth, there is a child variant called premium of waiver of premium option. The Bajaj product called Future Gain also has a waiver of premium option. So all of these Max Life online savings plan also has a waiver of premium option, where if the parent dies, there is a sum assured which is paid to the child right away, and the future premiums will be waived off. The insurance company will pay the future premiums, and the final fund value, which is the goal investment amount that you had wanted to create for your child, that will also stay protected and will be paid out.
Hmm. There's a question coming from Sheikh Zahid. Why can't we reduce the minimum premium amount to rupees 1,500 during the pandemic?
So Prashant, there are a couple of options that are available even at 1,000, starting 1,000. So if you were to check the HDFC Life Click to Invest product, which is a 5G ULIP where there are no charges apart from fund management and a mortality charge, that product is available starting at 1,000 rupees a month. And there are other options like the Max Life online savings plan. Even that starts at 1,000 rupees per month SIP. So there are options available with 1,000.
Hmm. There's another question. What's the best investment in the times of Corona? This has come from many people. Raja, Ratan, Firoz, S. Ganesh Babu, Shankar Mandal, Debashish Chakravarti, and Arindam Chakradar. Also, just to clarify, Santosh, there are a lot of questions coming in with, 1 year horizon, 2 years horizon. I think it's worth reiterating that when you buy or when you invest through insurance, it's a 15, 20-year kind of an investment. It's not a short-term 1 year, 2 year investment.
Yeah, so if your horizon of investment is less than 5 years, then insurance is not the product for you, definitely. And if you were to look at other options, you would look to mutual funds as the alternate option if you have a shorter term horizon, which is say 1 year or 2 year. And even there, just be careful that do not invest through small cap or mid cap. Invest through large cap if you have a horizon of that short termish, because small cap, given the pandemic, you do not know how small cap companies may survive, how the balance sheets will look like. So you would better stay invested with large cap at least if you were to start today, and if your horizon was a year or 2 year. So choose mutual fund and choose either debt or choose large cap equity.
Here's an interesting question from coming in, which is there a combination of an endowment plan available with a health insurance policy? This is from Amarlal Bhagwani.
So there isn't a readily available solution. And even if one were to create a readily available solution, there will be no unique benefit of combining the two. So one should just go with an investment option. And when you say endowment, I would suggest go for a fixed benefit product. Like there are products like Sanchay from HDFC Life, which give you 5.5% return. But these returns are guaranteed and these returns are tax free, which are very comparable to a fixed deposit, both in terms of return. Also, because these are tax free, unlike a fixed deposit, so you're better off investing in these. And these 5.5% kind of returns are fixed for the next 15, 20, even up to 40 years. You could choose a time horizon as long as that. So choose that for your investment objective and just go for a regular health insurance mediclaim indemnity product to cover yourself for health. And now there are products available which offer you almost up to 1 crore of health protection. So there are products available and a at very affordable price. So if you were a 30-year-old, a 1 crore health cover is available at 10, 12,000 rupees a year, which is almost, which was, if you were to look at just 1 year back, this was the amount you would pay for a 5 lakh cover. So today, 1 crore cover is available at a 10, 12,000 rupees annual price. So you should buy a health mediclaim indemnity product for yourself and separate that from the investment product.
Here's a question from Nishit Bhandari. What happens if the insurance company providing ULIPs goes bankrupt?
Okay, so just to tell you that whether it is an investment plan or whether it's a term plan or any other product that they buy from an insurance company, if an insurance company goes bankrupt or closes down, that portfolio is shifted to another insurance company which is there in the market today. So that portfolio will always be serviced by another insurance company. That portfolio we can never be closed, and that's an IRDA mandate to insurance. So, for example, Shriram Life, for example, was an insurance company, and a lot of customers would have bought their product. When that company closes down, see another insurance company, which is say ICICI Prudential Life, will take over the portfolio and continue to service those customers. So your policy, if you buy it through an insurance company, will stay protected. The worst that may happen is that the brand who's servicing you may change, but the product can never be closed down and you can never lose the money. And that's one thing which is very peculiar about the regulatory body, which is IRDAI, who has done this to protect the interest of policyholders in insurance.
Yeah. We'll wind up after this. Uddhav has sent this question. Which plan is best for my 6-month-old child for his education? I want to invest 1,000 rupees per month.
You could start with the Max Life product. There's a Max Life product online savings plan, which allows you to start with 1,000 rupees a month. The benefit of this product is that if something were to happen to you, the 1,000 rupees will continue to get paid by the insurance company. So the final amount that you expect to generate, the corpus that you expect to generate for a child, that will stay protected. And whenever, if the parents that happens, there's also an additional sum assured, which is, if you invest 1,000 rupees a month, the 12,000 rupees is what you will pay annually. So there's a 1.2 lakh of sum assured, which you will generate, which is a protection cover that you will generate. So if that happens, 1.2 lakh is paid to the child right away. The 1,000 rupees per month will continue to get invested, and the insurance company will continue to invest on your behalf. And the final corpus will also stay there and will get paid out at maturity.
All right, we'll leave it there. Thanks very much, Santosh, for joining in. And thank you very much, all of you who've been patiently listening. Lots of questions. Some of them were pertaining to specific stocks, which we can't really answer here. Many of which were talking about market timing. Again, insurance is not about market timing. It's a very long gestation kind of a product, 10, 15, 20 years, I believe. While there is a 5-year lock-in in any case in all the insurance investment plans, but the longer, for example, retirement, a child's education needs over the next 15, 20 years, these are the reasons or the goals for which you invest through insurance. There's a very quick question from Amit Sharma, and he's requested me to take it. Which is more beneficial, investing in gold ETF or a ULIP for 15-year horizon? I would imagine, Santosh, that if he does invest in a ULIP, they would also be taking some gold exposure. Are they allowed to take that?
They mostly, you will not be able to take a gold exposure. Most insurance companies do not take a gold exposure when they invest through insurance. I think, and these are two very different investment approaches. So if you're taking, I think, a 15-year view, you could invest through insurance, which is, I would say, gives you more security and go through debt where your investment is more secure. Plus, you get a decent return, which is tax-free.
So, Amit, most financial planners say that your gold exposure should be at best about 10% of your total corpus that you have invested. So, your debt equity should comprise of about 90%. Gold, if you want to, should be at best about 10%. I know prices of gold are zooming, and therefore people are beginning to compare gold with equity. That may not be the right thing to do. But anyway, thank you very much, Santosh, for coming by, and thank you all of you for joining in. Look forward to many more such conversations. Thank you.
Thank you, Vivek. Thank you.
Thank you, Vivek. Thank you, Santosh. Thank you, everyone.